No. So this is Nvidia. So it was their fourth quarter 2025, Steve. Yeah, your favourite. And obviously their full year as well. So revenue for the quarter came in at 39.3 billion, up just 79%. Net income 22.1 billion, up 80%. That's about a 56% margin, so pretty impressive. Operating cash flow 16.6 billion, up 45%, about 42% margin. Free cash flow 15.5 billion, up 38%. That's about a 39% margin. So, for those people who think they must be coming up against tough comps soon, this actually marked the second year of Nvidia's AI boom. So, these are the tough comps that they were supposed to be coming up against, and they're still growing at a really impressive rate. Just to break that down for you then, Steve, so computer networking was 36 billion, that was up 101%. Graphics was 3.3 billion, down 22%. Data center 35.6 billion, up 93%, and that's made up of compute 32.6 billion, up 116, and networking, which was 3 billion, down 9%. Gaming as a segment 2.5 billion, down 11%. Professional visualization was up 10%, 511 million, tiny part of the business now. Automotive, the same, up 103% to 570 million, but a tiny part of the business. And OEM and other, 126 million, up 40%. So if you want the full year as well, Steve, revenue 130.5 billion, up 114%. Net income 72.9 billion, up 145%. That's a 56% margin. Op cash flow of 64.1 billion, up 128%, 49% margin. And free cash flow of 60.7 billion, up 125%, a margin of 47%. And again, those segment and platform numbers. Computer networking, 116.2 billion, up 145%. Graphics, 14.3 billion, up 6%. Data center, 115.2, up 142%. And then obviously that breaks down into compute, which is 102.2, up 162%. 13 billion for networking, up 51%. Gaming, up 9% to 11.4 billion. And then the other tiny aspects of the business, up 21%, up 55%, and up 27%. If you want it by geography, Steve, this splits it in the weirdest way ever. US revenue, 61.3 billion, up 127%. Second on the list, Steve, is one that we covered a couple of months ago. Singapore revenue, 23.7 billion, up 247%. Taiwan revenue, 20.6 billion, up 53%. China and Hong Kong revenue, 17.1 billion, up 66%. And other includes, think of the countries that are in other. 7.9 billion, up 131%. So Singapore outspending other by essentially 3x. Sorry, is pretty crazy. For the first quarter, they said that revenue is going to grow at about 65%, so not stopping yet, Steve. That'll take them to about 43 billion, and they reckon the GPM, gross profit margin, will be about 70.6%, which is actually a decline. And they said that this is mostly because Blackwell is more expensive for them to produce, and it hurts their gross profit margin. In the call, Steve, they said that Blackwell's Q4 revenue on its own was 11 billion, which way exceeded expectations. It was the fastest product ramped up in their history. They said that production's now in full swing, increased supply and increased customer adoption, so we should see that continue. There's huge Blackwell clusters being built, and they're saying that the initial order for some of these clusters is 100,000 GPUs, sometimes more, and this is to power these really advanced AI models. And the shipment of these large-scale infrastructures has just begun. In terms of inference demand, a significant portion of Blackwell deployments are for inferencing. This is driven by the sort of increasing complexity of these AI models. Reasoning AI models require actually substantially more compute power than these simple models, and because of this, Nvidia is just seeing this large demand for inferencing at the moment. They're saying that Blackwell is actually designed for reasoning AI inference, and this offers increased throughput and lower costs compared to the previous generations of chips. They're emphasizing on this focus to reduce its inference costs and obviously to team that with improved performance. They said that they've got these three key scaling laws now, which is pre-training, post-training, and test time, which is inferencing. Post-training and inference are increasingly demanding significant computing resources at the moment. In terms of their competitive edge, they said that it's that they support various AI models now, and the scaling laws make it quite versatile. They said that CUDA's programmability and backwards compatibility have provided a lot of flexibility, and they actually protect infrastructure investments, which is why these big customers are making them. The general purpose GPUs are more accessible than a custom one, which is likes of Amazon and Google are building. Nvidia sees that the sort of a more general purpose one is better for the general market rather than a custom designed one. And they said that they also have got the ability to deploy systems much quicker than others, and that's one of their key advantages. They said that gross profit margins are going to continue to fluctuate just during this Blackwell ramp up. A return to higher margins will happen in the future. Strong revenue growth is projected through Q1 2026. And again, this is driven by this Blackwell demand. They said that CSPs, which is cloud service providers, they're still a significant portion of Nvidia's business. The consumer internet companies and enterprise adoption are also seeing substantial growth. Growth is expected to start ramping up in automotive and robotics as well. And China sales are about roughly half of where they could be because of the export restriction. So this could be even bigger, Steve, which is kind of crazy to think about. In terms of the outlook, they said that they'll maintain its annual product cadence. Blackwell Ultra will launch in the second half of 2026, and that's actual 2026, not just their weird year 2026. Nvidia is confident its long-term shift from CPUs to GPUs driven by this AI growth, and they said that essentially these data centers are becoming AI factories, and that's something that's very exciting to them. So there was loads of stuff in this call, Steve, that I haven't got really anything from the Q&A here. This is just mostly from their statements, but Nvidia really not saying this is slowing down anytime soon, Steve.
No, its share price is, though it's come off a bit since that report. It sort of pushed a little bit higher in post after the report and then fell about 8% the following day. That was yesterday as we're recording this. It started to just nudge a little bit higher now, but it's got some funny looking metrics that I was just sort of looking at for valuation purposes here. So price to sales is currently, it's trading sales, it's currently around 23, as near as makes no difference. Forward PE ratio is 21.5, which tells you something about the rate that this thing is growing at. And it's interesting to sort of see where you kind of get to in terms of growth. We've been talking about this for a little while now, and I don't think it should be a huge surprise to see strong predictions coming through the pipe here. We've been seeing big tech earnings, and you saw a lot of spending coming out of the US in that geographic breakdown that you mentioned. Apple have announced that they're planning on doing an awful lot of spending too, by the sound of it, which is building out what appears to be kind of AI farms or server farms or something like that in Texas, I think. So you expect to see more of that coming along. Blackwell is very, very strong. The big question I've always had with semiconductor stocks in general, especially leading ones like Nvidia, is how long they can stay ahead. And I actually heard something quite interesting on the Motley Fool's podcast this week. It was Asit Sharma who got the job of talking about it and the latest results. And what he was pointing out was, if you're looking for he didn't put it in these terms, but if you're looking for a moat, which I kind of am, and I'm always wary about moats in this space after having watched Intel go backwards and get it wrong, Nvidia does have quite good close relationships with all of the big hyperscalers and chip companies and designers and so on, and it is very well attuned to what they want and can do and need and how to make things better. And I mean, in that way, it's quite simply customer focused, and that should, if it can keep that kind of approach to things, generate more kind of growth and make it very, very difficult to disrupt, because it does have a big lead. Seen big leads disappear before in this space, and we can talk a fair bit about the whys and wherefores and so on, but they definitely didn't disappear on purpose. So it's possible to kind of make mistakes in this area, but that's the kind of thing that makes me more interested, thinking about things I can clear-headedly present to you and say that I genuinely understand why that would be a good thing. Close relationships with big hyperscalers is very welcome in this situation. Looks like DeepSeek hasn't really put much heat on immediate. I mean, it's not immediately the case that then sales have fallen off a cliff there, or are even going to in the next quarter or anything like that. Even if it turns out you can do sort of more with less by intelligent use of the computing power you have, fair enough. People are still just going to think there's an advantage to going out and buying as much of it as they can, including Apple as well, and Blackwell Ultra, next thing on the way. Always good to see the next kind of thing coming down the pike and what that looks like, and hopefully then means they're staying ahead. I ummed and ahed about it at sort of 21 times forward earnings doesn't sound like a terrible price at all, to be honest. The thing is that 21 times forward earnings is based on some mighty growth projections, which by this point I've given up saying you get a lot of plausibility for that kind of growth projection, having just seen it happen. So I don't get over the line on this particularly, but and it's weird. It's kind of not weird, but from a massive market cap, taking 8% off actually makes the thing quite a bit cheaper. It turns out. What do you think about it here, Steve? You mentioned you're big tech exposed. Don't fancy this one?
I don't know, because I felt like the sensible thing to do all the way along here was to be further down the chain, because at some point you just assume with these huge margins and this amount of growth that somebody else is going to come along and somebody else is going to be come along, and there'll be somebody who can outcompete one and outcompete the other, and also the major cloud service providers, they were all looking at making their own kind of chips as well. So it was kind of like the sensible place for me to be in that whole area was ASML. But like you say, Steve, at 20 times earnings, it's worth a punt, isn't it? I think AMD is trading in the same kind of area. You could pick them both up and maybe have a basket approach to this kind of data center come graphics card kind of area. I don't know, Steve. It probably needs a little bit more thought, mainly because the fact that it's trading at 20 times earnings is actually news to me. 20 times forward earnings is news to me. I didn't realize it'd come down so much. I was just looking at the share price as you said that, and it has had quite a rocky few weeks really. So it's come down to a level that might be palatable for people if you believe the growth they're stating is to be achieved. I'm not so sure like you, Steve. I'm probably not willing to wager the sort of money you would need to wager on a 3 trillion company to see that a decent return should that happen. But other people might see the risk reward in that, Steve. That maybe I'm not seeing right now.
I think I agree. This was quite a good set of, it was, as you said, everything seemed pretty solid and in order. And solid and in order by Nvidia standards is really, really good compared to anyone else's standards, by the way. I mean, it's just the usual strong outperforming growth stuff. And yes, the stock is expensive, but then if you look at where it's kind of worked its way back to, and you look ahead by a year or so, and you think it's even got one more kind of good year of this in it. So we go to 21 times earnings. Imagine another, don't have to double the earnings again for the time being. Think 50% over the next couple of years. Now you're looking at sort of 15 times earnings. That's not at all bad for Nvidia. So I see the point here with this, that it doesn't need to look too far down the line on this situation, but I don't love this space for possibly similar reasons to you, I think.
Yeah, interesting to hear what other people think though. I mean, does this tend your heads at home? Are you now seriously looking at an Nvidia acquisition? And let us know your thoughts in the comment section below. We'd be really interested to hear.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.